Hello and welcome. Today we will talk about Wells Fargo's fake accounting scandal case. You may have read about this in newspapers or heard it on television stations over the past 4 or 5 years. Obviously, in the banking industry, it was a huge scandal. So we'll talk a little bit about this case so you can become aware, and also so we can see what we can learn as professionals, as researchers regarding this case, and how managers in the future can create a more ethical culture for all their employees so nobody feels pressured to create fake accounts in their banks. So those of you who are not familiar with this case, basically Wells Fargo's 2016 scandal of fraudulent account practices violated banking laws as well as consumer trust. As a result, thousands of their managers and employees were terminated from their jobs for wrongdoings which appeared normal in their organization's culture when they were actually committing those wrongs. The bank's employees fraudulently opened up bank and credit card accounts, transferred money between those accounts, and created fake email addresses for online banking accounts in order to sign up customers for the bank's accounts. So they did a lot of things wrong just to make themselves look good as employees or as branches of the bank. Debit cards were issued and PIN numbers created without the customer's authorization or knowledge. Overall, millions of fake accounts were opened for customers during a 5-year period. Of course, the cross-selling activity was done without the customer's knowledge and consent, and thus was unauthorized, was fraudulent, was deceptive, was abusive, and it was illegal according to the American laws. Managers were pressuring employees to open multiple accounts for customers without the customer's knowledge to meet sales goals. Another diversity-related issue was that the bank employees may have singled out people based on race. More specifically, Hispanic customers were being the victims of their illegal sales practices more often. Luckily, there were several whistleblowers who raised concern about the opening of unauthorized accounts and credit cards, but they were supposedly retaliated against in the bank by being discharged. Consequently, the bank was investigated and found guilty. So when things appear normal in a company's culture, then we don't like complainers. So this is a problem. When employees complain about something, you as a manager, as a professional, should listen to why they're complaining. Try to look at it from their point of view and bring about relevant changes when needed. Eventually, more than 5,300 employees of the bank were fired because they had opened up over 2 million illegal accounts in order to meet and exceed sales quotas and to earn the extra fees from unwitting customers who did not know that they had fake accounts in this bank. The Wells Fargo scandal opened up the eyes and minds of many corporate executives to make sure their employees and managers are being legal and ethical in all their behaviors. Executive managers had to internally assess their company's culture to make sure employees are not tempted to cross the line in earning higher profits and salaries through questionable practices. Overall, it has led to some companies formally auditing their incentive plans or even restructuring their organizations, while also conducting more ethics training and legal awareness workshops in their organizations. The various measures are helpful in rooting out wrongdoing by individual managers and employees, while also greatly reducing the risk of companies being accused of committing such colossal illegal acts and scandals in the future. Wells Fargo has taken many actions to be a socially responsible and sustainable corporation. Wells Fargo has aligned its corporate social responsibility with the principal purpose of creating solutions for stronger communities. Overall, they have committed to diversity and social inclusion, economic empowerment, environmental sustainability, as well as philanthropy and volunteerism among their workers in their corporate culture. Diversity and inclusion seek to ensure that everyone is treated with respect at the company and that they all have equal access to resources, to services, and to opportunities for success. Since the pressure for unrealistic expectations and profit growth are high in the banking industry, I recommend that the banking managers and corporate executives continue to do the following. For example, number one, they can review their incentive plans and sales goals to make sure managers and employees are not tempted to utilize illegal or immoral actions to achieve their, let's say, weekly or quarterly goals. Hire an independent consultant to annually audit the company's sales procedures and practices while also surveying employees for their feedback regarding ethical standards and ethical behaviors. Require managers and employees to undergo ethical sales training. Develop a corporate culture of legal compliance and ethical behaviors. And finally, institute structures, practices, and channels to ensure legal and ethical compliance in the disclosure of any wrongdoing. Wells Fargo violated the trust of its customers and deceived and abused them in a disrespectful manner. Consequently, the bank and its employees are paying and will continue to pay the legal price for such flagrant wrongdoing. One lesson that we can learn from this scandal is that if a company sets up unrealistic sales goals and then ties the employees' compensation and their jobs to meeting these goals, then as a consequence, unethical and illegal behavior is very, very likely to occur, thereby resulting in harm to the organization, to their corporate culture, and obviously to their brand and other stakeholders like their shareholders. So the business leader must fulfill his or her legal and societal expectations and overcome unethical temptations in any organization's culture. By making good decisions, the business leader and employee will be able to achieve sustainable success for him or herself, for the company, for the organization, and for the relevant stakeholders, as well as the community and society in general. To make ethical decisions, managers and employees can ask the following questions. Is this action legal, moral, and would a socially responsible manager or firm take such an action? If the answer is no, then a person must find alternative actions that are deemed legal, moral, and socially responsible. As usual, my recommendation is that you read more academically published articles to understand the Wells Fargo fake accounting scandals case and to get more perspectives from different authors and different views. As a matter of fact, you're welcome to read this article entitled Wells Fargo's Fake Accounting Scandal and its Legal and Ethical Implications for Managers that was published in the Advanced Management Journal during 2017 by myself and Professor Cavico. It was published in the Advanced Management Journal, volume number 82, issue 2, from pages 4 to 19. So you're welcome to read that article if you're doing research in this area or on this topic. Keep in mind that the world has witnessed in the last few years major business scandals which involved giant companies which perpetrated massive fraud and deceit against their customers and other stakeholders. First in 2015 was the Volkswagen deceptive diesel emission scandal, and then again in 2016 the Wells Fargo fake accounting scandal emerged. How did Wells Fargo's focus on short-term gains violate the duties they owed to consumers, regulators, and employees? We must note that any bank, specifically Wells Fargo, does have a duty to consumers to treat them fairly and to ensure their accounts are protected and secured. It has a legal duty to regulators to obey applicable laws and to avoid fraudulent activities. It also has a duty to employees to treat them fairly, to provide them with adequate compensation for their work, and to ensure that work expectations are realistic. Finally, Wells Fargo has the duty to all its stakeholders to ensure their employees are acting in a legal and ethical manner every single day in all their actions. Instead, Wells Fargo's aggressive sales goals violated all of these duties. These goals embraced short-term profits over long-term ethics and social responsibility concerns. They also cost Wells Fargo in the long term with the massive $185 million fine and the firing of thousands of employees and the loss of trust in the company. Wells Fargo created a toxic organizational culture where employees were penalized if they did not meet aggressive and unrealistic sales goals. The company also did not have systems in place to ensure employees were actually engaging in selling. So this pressured employees to open up fake customer accounts and forge customer signatures. Those who spoke up about the misconduct were retaliated against. Many managers appeared to have known about the misconduct but did not do anything about it. This not only created the opportunity for misconduct, but actually encouraged it as part of their organization's culture. Wells Fargo betrayed its responsibilities to its customers. Employees opened fake customer accounts and even forged their customers' signatures to appear as if they were meeting Wells Fargo's aggressive sales goals. This harmed customers who did not want these additional products and did not purchase them. It also destroyed customer trust in the company. After all, if Wells Fargo could commit misconduct in one area, what is to stop it from committing misconduct in other aspects of their operation? This is especially disconcerting because, as a bank, Wells Fargo has direct access to customers' money. Finally, Wells Fargo neglected its responsibilities to regulators. The falsified customer accounts and forged signatures combined with management knowledge in whistleblower retaliation directly violated laws that were meant to protect employees and consumers. A more recent scandal occurred when the New York Times reported that more than 800,000 bank auto loan customers were charged for car insurance they did not require. Although this was discovered in 2016, the bank did not disclose it until next year. These continuing ethical challenges indicate that Wells Fargo has an unsettling culture which appears to tolerate misconduct. Without a serious turnaround in ethical behavior, the company's future may be in question. Describe how Wells Fargo scandal demonstrates that organizational leaders must not only establish goals, but ensure that these goals are being acted upon appropriately. One of the most outrageous parts of the scandal is management's apparent complicity with the misconduct. Investigations showed that many managers not only knew about the misconduct, but they appeared to encourage it to employees. Even without this complicity, however, Wells Fargo leaders are still at fault for not having appropriate controls in place to ensure employees were acting appropriately. Wells Fargo set unrealistic sales goals that pressured employees to cheat if they wanted to keep their jobs. It then failed to monitor employee conduct to make certain employees were actually engaging in cross-selling rather than creating fraudulent customer accounts while sitting in their offices or in the workplace. Without this accountability, employees could open fake customer accounts and forge customer signatures at will anytime they want to. If nothing else, the lack of controls to maintain an ethical culture puts organizational leaders directly at fault. Wells Fargo demonstrates how organizational leaders must constantly monitor and observe operational conduct to ensure employees are acting ethically in following applicable laws in every single city where they operate. Why are ethical values useless unless they're continually reinforced within the company? Well, ethical values are useless because unless they're reinforced within the company, they are little more than just words on a piece of paper. You've heard the statement that it's not worth the paper it was written on. In the case of Wells Fargo, the company had strong ethical values but did nothing to encourage their practice. In fact, managers rendered these values virtually meaningless by their unrealistic sales goals program and complicity in the misconduct. Organizational factors such as culture often have a stronger influence on employee conduct in the workplace, and for Wells Fargo, the organizational culture clearly provided the opportunity for employees to engage in fraudulent behaviors. Although Wells Fargo had all the right values on paper, the conduct of their managers demonstrated to employees that the company's expectations of them were quite different than what was in the corporate code of conduct. So the employees and managers were not modeling the values that they professed to abide by. I like this poem about The Man Who Thinks He Can by Walter Wintle. It was supposedly written in 1905. It makes a good statement that if you think ethical, you will become ethical. If you have high standards of your organization's culture, you will get an organizational culture with strong ethical values. But you have to be role modeled, you have to talk about it, you have to emphasize it, and you have to think about it all the time. Let us look at this poem by Walter Wintle. He wrote that if you think you are beaten, you are. If you think you dare not, you don't. If you would like to win, but you think you can't, it's almost a cinch you won't. If you think you'll lose, you're lost. For out in the world we find success begins with a fellow's will. It's all in the state of mind. If you think you're outclassed, you are. You've got to think high to rise. You've got to be sure of yourself before you can ever win a prize. Life's battles don't always go to the stronger or faster man, but soon or late, the man who wins is the man who thinks he can. If you think you can create an organizational culture that is seen as ethical, you can. If you think you can just go with the flow and do what everybody else is doing, even though you think it's wrong, then unfortunately you have already beaten yourself and you've become part of that unethical culture. So you must set high standards in every organization where you work, and obviously have high standards of professionalism for yourself before you can expect it from others. As always, remember that ethical behavior is a skill. So you need to think critically while policing, evaluating, and improving your ethical muscles at all times. Good luck. Remember that if you're doing research, you can always use these references to find more material on this case. And hopefully you can look at the company's website to see what they have done since that time to create a high level of trust between themselves and earn the trust of their consumers in the years to come.